Welcome back to Fast Market right here on Schwab Network. Right now, the Dow Jones Industrial Average up 321 points. The S&P's up 55 points. This after selling off last week. The S&P dropped 1.6% last week, and it was down for the third week in a row. We're watching shares of Meta rising. A report from Reuters that the company is planning to lay off about 20%, over 20% of its workforce in order to help to cover some of the costs from the massive investment in AI infrastructure. Meta employed about 79,000 people as of the end of 2025. Is that too many? Also underwent large layoffs about 2 years ago. You may remember that, when about 13% of the workforce was let go. And it's my understanding that this move here will save about $5 to $6 billion in cost savings. And JP Morgan put an overweight rating of and an 825 target too. It's worth noting that. So we welcome back here to our conversation Tom White and Joe Mazzola. Joe, your thoughts on Meta?
Look, you talk about $6 billion in savings a year. Yeah, that sounds like a lot, but at the same time, when they're generating, $165 billion in capex expenses on average, or at least that's what's projected going forward, that's not going to make a big dent. And so I think, look, Meta has made it clear that their path going forward is going to be led by AI, and they're investing in it. They signed a 5-year AI infrastructure deal recently with Nebius. That's worth $27 billion. You got to free up money in order to do all these expansion plans, and that's kind of what we're seeing with the workforce. I think there's two ways to look at this. Number one, you definitely feel for the employees and their families, of course. But I think the second way to look at that is it's possible that Meta is actually starting to see the AI rollout, produce some dividends at this point, because they feel that they can do the same amount of capacity with a smaller workforce, a 20% reduction in workforce, even further. So I think it's interesting to look at it that way. There's been no signs that they're going to slow down on that AI capex spend. And, interestingly enough, the shares have been kind of in the penalty box. I think we'll get that signal within the next couple of weeks.
All right, what do you think here, Tom? And by the way, unlike NVIDIA, these shareholders have had some frustration. When you look at the Mag 7, these are not the happy Mag 7 shareholders. Meta over 1 year is up 5%, 5.5%. Tom, your thoughts on Meta?
Yeah, bear market territory. And the stock's only up 1.8% today on this news. So, yeah, 3.5 billion daily active users across their platform. That's the positive part. They're continuing to grow in double digits, but the capex spend, Joe mentioned that, the total is $165 billion expected this year. And now they're going to cut 20% of their employees. Well, this goes into that thesis that AI is going to make everybody more productive. So if you start cutting employees, it's one of the biggest expenses, besides maybe this capex spend on AI build out. That should be beneficial to shareholders. But as Joe mentioned, this stock has been fits and starts over the last several months, especially since the last couple of earnings events where the stock shot up and then, fell pretty substantially with that $600 being kind of a base here. But yeah, if it comes to fruition, I mean, they haven't really confirmed the reports. It's supposed to take place over a year. I just don't think this is going to be the last one. If you're starting to see this across software, we saw it out of Block, where they're going to cut 40% of their workforce. We saw it out of Amazon. I think this is going to be the theme, where AI is going to create more productivity for these companies, but that means they're going to have to start cutting employees. And we've already seen it. New college graduate unemployment levels are, probably double what they are just standard unemployment rates at this point, maybe even higher, they're starting to say right now.
Yeah, and look, our high of the day was 634, and we're at 624, so we're already $10 off of the high. And to your point, you also saw the low last week, along with the major market averages for this year, right? The S&P hit its lowest point on Friday of 2026. All right, thank you for that.